Life Insurance Secrets Revealed. My name is Javaughn Spencer. I'm your verified advisor, here to bring you all of the secrets, all the tips, all the tricks, everything that you need to know about life insurance. Life insurance for children. No one likes to talk about the life insurance for children, but it's really one of the best vehicles out there available for them. Life insurance for children, they're ideal for families that want to protect their children while you're young. Life insurance increases when you get older, so it's best to put coverage on them as young as possible. Most life insurance companies won't insure a child under 14 days old. So once they're 14 days old, you're able to get them coverage. This is good. Ideal for families that want to use life insurance as a vehicle to grow their wealth and prepare for their children's wealth in the future. And we're going to cover that today. My name is Javaughn Spencer. Here's my family, Bridget and Javaughn. We're verified advisors. You can check us out on AdvisorVerified.com. Have two sons, Brendan and Darian, 18 and 11, and we're here in beautiful Beaufort, South Carolina. Here's my national producer number. I'm licensed in 48 states. My direct number, my email, my website. My wife and I, we own a brokerage. We've created partnerships with multiple life insurance companies so that we can make sure that we have your best interests at heart. We're not married to any particular company, so we can make sure we shop around for you, get the best rates and everything. Now, term versus permanent, okay? Well, guys, I'm going to share with you for children, there is no term option for children. The chance of a child passing away before 18 it's devastating, but it's kind of rare. They put permanent options in place. So we know that there's term and permanent for adults, but for children, there is no term. So they're permanent. So let's go over the option for permanent when it comes to this. Permanent is guaranteed to pay a death benefit when you pass away because it lasts your entire life. Correct. Again, permanent, it's less expensive if you lock it in at your child's current age. So the quicker you can lock them in, you'll never have a payment increase again. And that's awesome, because imagine that, if you do a $50,000 or $75,000 policy on a kid that's one, that's the same price they would pay when they get to 71. It's just a huge savings, because if you get $50,000 or $75,000 when you're 71, oh my goodness, compared to what it would be if your parents were to get it when you were one. Just huge savings. Nice, builds cash value, which can be accessed while alive. And we're going to show you that there's certain policies out there, there's certain plans that allow your children you can prepay for their retirement, make them become a millionaire up front, no hesitation, no get rich quick schemes, just strategic financial planning with no risk of loss. It's easier to qualify for permanent with health conditions still to this day on the children and the adults, and some carriers offer living benefits. So we're going to go over three major types of plans when it comes to children policies. The biggest difference with selecting them is really your budget. Okay, so let's go over it. The first plan, that's your traditional whole life insurance policy for your child, can range from having a $10,000 policy. I have plans that I'm looking at the rate sheet for $10,000. You're looking at companies that have it for $5 a month if they're between the ages of 14 days old to 4 years old. $10,000 policy for the rest of their life, whole life, is right around $5 a month. 14 days to 4 years old, going all the way up to $75,000 plans, can be right at $27. So this is your traditional, just getting a policy in place to where if the unthinkable happens, you wouldn't have to do a GoFundMe or fish fry or anything like that, beg, borrow, steal at the time of devastation. Now, one thing that I want to bring up, completely against one thing when it comes to life insurance, and this is putting your children as a rider on your life insurance policy, mom and dad. I completely do not agree with that, because when you put your child as a rider on your life insurance policy, you might be saving $1 or $2 a month, but what happens is that child falls off your policy when they get 20, 24 years old. Now, 20, 24 years old, anything that pops up in that child's life on that journey, they might not be insurable. They might not be able to get the same coverage, and you saved $1 or $2 instead of locking them in for life when they were 4 or 5 years old, or however old they were when you first started the policy for yourself. So I'm saying this needs to be a policy just for your child so that it can grow with them. Hop on your policy. So that's my soapbox there. Riders are not good at all. Seen too many situations where a child was uninsured because the policy was a rider, and the family found out the hard way. They found out at the time they needed it, and it was in black and white. It was suggested, but it's really explaining why they should not have done that was critical. But let's go over this protection plan. For a child, it's a death benefit. Child passes away, it pays out. If they become terminally ill, okay, from a doctor's note where they were told they have 12 months or less to live, if that was the case, you can access that policy up front to make final arrangements. It's not have to be a death benefit only. So that's your foundation. That's your ones that you see all over the place, just a regular, straight children's whole life policy. Like I said, from $10,000 all the way to $75,000, it's a range from $5 to $30 a month. You can go beyond that to $125,000, and you're looking at under $50 a month if your child is between 4 years old and under. These plans are going to be available for children that's 17 years old and under. So these are whole life policies if you're 17 or under. That's actually what's considered children, 17 and under. So here's that next level. Here's the next level of permanent whole life policy for your child, right? And this includes a lot of living benefits that I want to go over. This is including, start from the bottom, a death benefit. This is if you pass away, if your child passes away, it pays out. Chronic illness. Lord forbid if your child is unable to bathe himself, dress himself, feed himself, hold their stool or walk for 90 days or longer with doctor's notes and doctor involvement, then you'll be able to access the death benefit up front. To use that for treatment, for whatever's needed, no questions asked. That's what chronic illness, and again, is on your children's policy. Critical illness, heart attack, cancer, stroke. It's the same as the adult. Children get cancer. We don't like to think about it. We don't like to talk about it, but it happens. So many commercials and people fighting it that you may know about right now. There is life insurance policies that protect your child from 14 days old and beyond from any of this taking place. Okay, so that's another option there. Terminal illness, being told you had less than 12 months to live. A policy can be protected to pay that policy death benefit up front. And again, death by accident, slip and fall, like just anything that's not health related is considered an accident. So with these plans, these are children life insurance plans with living benefits. You can choose to have this as an option for your child. Those are the plans that's strictly just about health, passing away, life, living, all of that in one. So now we want to go to a little bit further and talk about having all those lumped in, but now adding another component, the savings component. Okay, so let me show you how you can now build wealth using your child's life insurance policy for them, for you. You can do the same for you as well. You can look at that series there. So I call it the tax-free secure account for kids. You're going to see a lot of similarities in the same tax-free secure account for adults. But these are a deal for parents or grandparents that's planning for college. Maybe you don't want your child to go to college. You're not planning for college. You're planning for entrepreneurship. Maybe you're not planning for either. You just want to make sure that during the most important milestones of their life, they have cash there. If they're buying a car, buying a home, planning a wedding. This is also ideal for families that want to make sure that their loved one don't struggle like they did and have a retirement. They might not want to retire at 60, 65. I believe they're pushing retirement even further. They can choose when they want to do for retirement. So that's what this is for, planning for the future for our children. So what is a tax-free secure account? So in layman's terms, this is taking advantage of IRS Code Section 7702, where all you're doing is overfunding a life insurance policy. So what does that look like? Section 7702 allows you to put a lot of money in a life insurance policy and pull out the money tax-free. It looks like this. You make a premium payment and it's going into a jar. Let's just say it's going into a jar called the IUL, Index Universal Life Policy. But in that jar is doing two things. Your money is doing two things. It's purchasing a tax-free death benefit, and it's also putting money to the side into a tax-free cash account. Now, I like this illustration because I want you guys to know that the death benefit is where let's going to break it down here. What is an IUL? The best analogy I've heard is the IUL is like marrying the Roth IRA with a life insurance policy. It's a permanent form of life insurance and your money grows guaranteed. There's no risk of loss on these types of policies. There's two components, there's two sides. I showed you the life insurance side. This protects your children from death, critical illnesses, cancer, stroke, heart attack, accidental death. It gives that the worst case scenario protection in mind. It covers that. But also, it's the tax-free cash account, right? This, like I said earlier, can be used for education, starting a business. Another thing that my clients love these policies for is because you don't have to report it on your FAFSA. You can have $200,000-$300,000 in these accounts and don't have to put it on student loan documents because it falls under life insurance. You can create a tax-free retirement income for your children and it's guaranteed. No mystery if they're going to do or have what you have. You can go ahead and start preparing for their future up front. Here's an analogy that I love, an example of doing it yourself and leveraging the power of a tax-free secure account. First thing first is $100 a month. If you save $100 a month, when Timmy gets 18 years old, you'll have about $20,000 if you don't touch it. If you never touch that money, well, when Timmy's 18 on a tax-free secure account, because of the interest that it's earning, you have $36,000. And this can be used for school. This can be used to start a business. This can be used for yourself if you wanted to. No questions asked. Again, now you still contributing $100 a month. Now Timmy's $30,000 is now subjected to garnishments and lawsuits. You're now vulnerable for the world, where if it's in your tax-free secure account, Timmy can use that to purchase a home, start a family, and it's not subjected to garnishments and lawsuits because it is protected by a life insurance policy. And now at the end 65, you now have $100 a month, but because the tax-free secure account has the power of compound interest, Timmy is now owed and have access to $1.6 million worth of tax-free income and life insurance and permanent life insurance that's not going to term out. This is really just a eye-opening of this is what it looks like between saving $100 a month for yourself if you're disciplined enough to never touch it, and leveraging the power of compound interest and life insurance. It gives you something valuable, security as a parent. Right here, this is where we'll be able to customize your plan. If you want to do just a traditional whole life, where it's just the terminal illness and the death benefit, which is great, that is 100% okay. Or if you want to do the tax-free secure account plan, I would say those would need to start closer per child, probably closer to $75 to $100 or more for it to make sense with those plans. Again, that kind of gives you the price range. The children's one, that's just a straight whole life, you can see that starting from $5 to $25, $30. And then if you want the extra benefits that includes the living benefits for your children, you can go ahead and kind of expect to be around $75 to $100 a month for those policies. Again, we're assuming everyone's healthy, no medications, no medical conditions, because if that's the case with these type plans, they'll have to have a good bill of health. Now let's continue on to the, I would call it the Cadillac plan. Going to be prepaying for college. You know that college is for you and your children, and you know that it's going to be your bill or their bill, and you really don't want it to be their bill. What we call these are prepaid college plans. Prepaid college plans, and we're going to go over the difference between these and the 529 college plans. And again, another form of life insurance that's ideal for parents and grandparents that's planning for college. This is really, really, really huge to get in front of this now, because tuition and everything is only going up. All right, so we like to bring up, there's 3 ways to pay for college. So as I speak to you, there's 3 ways. It's either going to be from savings, it's going to be from your current income, or future income. Savings is how much have you saved today for college for your children. Cash flow, do you have enough of your current income to be able to afford their new college bill? And future income is them borrowing student loans and you paying the future, or them paying the future debt, which, as we know, will slow them down in life, that they're applying their current money to past debts. I always ask, do you have savings set aside for college? Well, guys, most of the families that I meet, they don't have savings set aside for college. Are you confident that your current income will be enough for your future expenses? Most of the families that I meet with, they're not confident that they can take care of their bills and the bills of their child as the student loan and as tuition and inflation and everything gets more expensive. And do you have a plan in place to pay off any future student loans? Well, we really have no choice if they want the children to go to college. So they'll put, it's still wobbly. Unfortunately, the 3-legged college stool has collapsed. And that's just the reality for most families. Like I said, compare between the prepaid college plans and the 529 college savings plans. Let's go through it. Now, first and foremost, tax-free growth. The prepaid college plans have tax-free growth, where the 529 plan, any growth from that is going to be taxed. Okay, a tax-free death benefit. No, there's no death benefits in the 529 plans. The prepaid college plans have a life insurance component. Protection from cancer, heart attack, and stroke. Yes, for the prepaid college plans, but no on the 529 plans, because that is strictly money. That's strictly money going into the market with the intention of using it for college. Guaranteed income, retirement income for life does not exist in a 529 plan. It does exist and have the ability to be accessed on the prepaid college plans. This is a big one. Penalties for using your money for non-educational withdrawals. You do not get penalized on a prepaid college plan, but you do get penalized on a 529 plan if you use it for something that's not educational. That's the whole entire point of those plans. With the prepaid college plans, you can use it for anything. Oh, a big one, your child wants to travel abroad for school, your 529 plan cannot do it. But your prepaid college plan can, because there's no questions asked on why you need the funds. Market risk, nope, no market risk on the prepaid college plans, but you have market risk on the 529 plans. When the stock market goes down on the 529 plans, their money goes down. People still have to come out of pocket to pay for college, even though they spent all of those years planning for it. But because they put their money in a 529 plan, they still have to pay out of pocket because the market took their money. Required to be on FAFSA forms. That is a no for prepaid college plans, but a yes for 529 plans. Accepted by all 101 HBCUs. Both of them are accepted by all 101 HBCUs. And here's a kicker. The prepaid college plans can actually be used for entrepreneurship and trade schools, where the 529 plans are just available for universities and community colleges. It really just shows you the huge limitation that's really, really sad, actually, between having a 529 plan and a prepaid college plan. A prepaid college plan is, again, just overfunding a life insurance policy. So leveraging section 7702 of the tax code that allows you to put money into a policy, and it goes in two directions. It goes into your tax-free death benefit, and it goes into your tax-free college fund. The IUL is like a Roth IRA married to a life insurance policy. It's permanent life insurance, and the money grows guaranteed. So those two components of an IUL protects your children from death, critical illnesses, cancer, and accidental death. And it also can be used on the tax-free college fund. Okay, still being able to use for education, but if your child don't want to go to school, then you can use it for a business. You can use it for your business. Real estate is huge. Having a wedding, down payment on a car, down payment on a home. We went over Timmy again, so just want to make sure you see it, like it's there. Security, and you can structure and have a prepaid college plan protects you for everything, all aspects of life, health, ailments, sickness, disability, protects you all the way for your child's life. But what I want to do while we're here, take a look and see, let's do some examples. So let's just say I have a daughter, and my daughter is currently 12 years old. 12-year-old female. So let's walk through this, what this looks like for your family. So a daughter, 12 years old. If I contribute $100 a month for 20 years, my daughter's 12 right now, and I pay $100 a month until she's 32 years old into this policy. That $100 a month, when my daughter turns 18 years old, she can begin taking out $2,800 a year. What would I do that for? That can be for school, that can be to start a business, that could be for any reason possible. But we chose that 18 to 24 because that's about the education zone. $2,800 a year for 6 years. Well, then remember, I'm contributing only $100 a month for 20 years. Now when she's 30, she can start to take out $6,000 a year from age 30 to 35. Now remember, I'm only contributing till she's 32 years old, so I'm done. In the midst of this $6,000 a year, I'm done paying for anything into this policy. So the policy's just accruing compounding interest year after year. And now, ladies and gentlemen, when my daughter's 50 years old, she'll have $140,000, give or take, in this account. Or she can decide that she just wants to take $10,000 out a year for the rest of her life. Think about you right now. If you had a plan that right now, whatever age you are, and every year you receive $10,000 a year, what could that do? What would that make easier for you? These are the insurance secrets that they don't want you guys to know about. right here. Let's say we take it up a notch and you contribute $250 a month for 20 years and your daughter's 12 years old. Well, when she hits 18, she can start pulling out $7,000 a year for the next 6 years. When she hits 30, she can start pulling out $16,000 a year for the next 5 years. But when your daughter is 50 years old, she can either pull out $350,000 or just receive $28,000 a year for the rest of her life. Amazing. You are prepaying for your child's retirement by leveraging life insurance. And as you see other examples, $500 and $1,000. This is why I was saying earlier where it's all about what's affordable to you. If you only can afford the straight whole life for your child, start there. Okay, if you want living benefits a little bit higher, start there. But if you want to be able to prepay for college, prepay for their retirement, that's where you're in the $100 and more club. Let's go, say I have a son, and let's say my son is 6 years old. 6-year-old, I'm contributing $100 per month for 20 years till my son is 26 years old. When he turns 18, he'll be able to access $5,600 a year. Now, let's stay there. Let's still say that's not enough for college. He still has to get student loans. You can use that money to pay the student loan bill so it's not coming out of his pocket. If that's a huge reality, like prepaying for student loan debt is amazing. When he hits 30 years old, he can take out $10,000 a year. What do you use that for? Marriage, starting a family, down payment on home, starting a business. It's his prerogative or your prerogative. And when he hits 50 years old, he can access $11,000 a year or say, hey, cash me out. Thanks, Mom. Thanks, Dad. $200,000 at your fingertips. Way back when Mom and Dad started contributing $100 a month into my life insurance policy. Same with $250 a month. $15,000 a year. That's about the cost of some of the prestigious universities, $15,000 a year that you can just pull out of your child's life insurance policy. You have the ability to have a $500,000 account value for your child when they hit 50 years old based off contributing $250 a month for 20 years when your child is 6 years old. Amazing. Let's go female. Let's go a little bit older. Let's just say we're starting a little later and our child, she's 17 now. As you see, the longer we wait, the less the money and the growth goes when they hit 18. While she's 3, that $100 will give them $15,000 a year, $42,000 a year at $250 a month for just 20 years. This is structured just for contributing for 20 years. Amazing. You can do this for your children, grandchildren. We just want to share with you the secrets of how the rich stay rich and the wealthy stay wealthy. Feel free to jump on my calendar. Feel free to ask questions. We can jump in. We can do this for you. Give me your children's ages. Feel free to send an email. We want to make sure you're totally aware of what's available to you and your family. So please hop on my calendar. We'd love to help. Till the next series, till the next episode, have a good one. Peace.